Welcome back to the channel, and thank you for joining me today. If this is your first time here, this channel is dedicated to breaking down global markets, macroeconomics, and financial risk in a clear, practical, and honest way. Right now, trillions of dollars are quietly moving across global markets, and most people have no idea why. Gold is trading at historic highs, not because of hype, but because fear, policy, uncertainty, and geopolitical risk are reshaping how money seeks safety. At the same time, traditional safe haven currencies like the US dollar, the Japanese yen, and the Swiss franc are behaving in ways that challenge long-held assumptions. This is not a normal market cycle. This is a global reallocation of trust. In this video, I will break down why investors and central banks are flooding into gold, what safe haven currency flows are really telling us, and how inflation, interest rates, and Federal Reserve policy are driving these moves. We will examine why the US dollar remains dominant yet increasingly questioned, how de-dollarization is changing reserve strategy, and why central banks are accumulating gold at a pace we haven't seen in decades. I will explain how real interest rates, government debt, geopolitics, and market psychology interact to shape safe haven demand, and why these forces matter directly to US investors. We will compare gold to safe haven currencies, discuss whether alternatives like Bitcoin truly function as protection during market stress, and look at what history teaches us about capital preservation in uncertain times. Most importantly, we will look ahead at realistic future scenarios, expert forecasts, and what all of this means for portfolios, retirement planning, and long-term financial security. This video is not about chasing headlines. It is about understanding where global money is going, why it is moving there, and how to think clearly in a world where certainty is increasingly rare. A deep expert analysis for US investors and global market watchers. Introduction: why safe havens matter. Right now, financial markets in the United States and around the world entered 2026 with a heightened sense of caution, uncertainty, and defensive positioning. Investors are increasingly focused not on how much return they can generate, but on how much risk they can avoid in an environment shaped by geopolitical instability, monetary policy ambiguity, and slowing global growth. In this environment, capital naturally migrates toward assets that have historically preserved value during crises, downturns, and systemic shocks. These assets are known as safe havens, and in early 2026, gold and select currencies are dominating this conversation. The scale, speed, and persistence of safe haven flows this year suggest something deeper than a short-term panic. Market behavior indicates a structural reassessment of risk, trust, and long-term capital preservation. For US investors, understanding why money is flowing into gold and certain currencies is no longer optional. It is essential for portfolio protection, macro awareness, and long-term financial planning. What is a safe haven asset? A safe haven asset is a financial instrument that tends to retain or increase its value during periods of market stress or economic uncertainty. Safe havens attract capital when investors lose confidence in riskier assets, such as equities, high-yield bonds, or speculative investments. The defining characteristic of a safe haven is trust rather than yield. Investors accept lower returns or even zero income in exchange for stability, liquidity, and reliability. Gold is the oldest and most universally recognized safe haven asset in human history. Certain currencies, particularly the US dollar, Japanese yen, and Swiss franc, also function as modern safe havens. Safe havens do not eliminate risk, but they reduce exposure to catastrophic loss during systemic events. In 2026, the demand for safe havens reflects deep concerns about the global financial architecture itself. Why safe haven demand has intensified. In 2026, the intensity of safe haven flows in early 2026 is not driven by a single crisis, but by the convergence of multiple global stressors. Geopolitical tensions across multiple regions have increased the probability of supply disruptions, sanctions, and military escalation. Global trade remains fragile as economic nationalism and protectionist policies continue to reshape supply chains. Inflation remains structurally higher than pre-pandemic norms despite aggressive monetary tightening over the past several years. Interest rate uncertainty in the United States has created volatility across equities, bonds, and currency markets. Government debt levels in advanced economies have reached historic highs, raising long-term fiscal sustainability concerns. These factors collectively undermine confidence in traditional growth-oriented assets. As confidence erodes, capital seeks shelter. Gold's role as the ultimate safe haven. Gold occupies a unique position in the global financial system because it is no one's liability. Unlike currencies, gold is not issued by a government or central bank. Unlike bonds, gold does not depend on a borrower's ability to repay. Unlike equities, gold does not rely on corporate earnings or economic expansion. Gold's value is derived from scarcity, durability, and universal acceptance. In times of crisis, these characteristics become especially attractive. This explains why gold prices have surged to record levels in early 2026. Gold prices in January 2026. As of late January 2026, spot gold prices have surged beyond $5,200 per ounce, marking an all-time high. This rally represents one of the most aggressive multi-year advances in gold's modern trading history. Gold has gained more than 60% over the past 12 months, far outpacing most major asset classes. The rally has been driven by both institutional and retail demand. Unlike speculative spikes of the past, this move shows strong participation from central banks and long-term investors. This distinction matters because it suggests durability rather than excess. Central banks and the global gold accumulation trend. Central banks have emerged as one of the most powerful drivers of gold demand in recent years. In 2025 and early 2026, central banks collectively purchased hundreds of tons of gold for reserve diversification. Many of these purchases came from emerging market economies, seeking to reduce dependence on the US dollar. However, advanced economies have also quietly increased gold allocations. This behavior reflects growing concern about geopolitical leverage embedded in reserve currencies. Gold offers neutrality in a fragmented global order. Once central banks acquire gold, they rarely sell it aggressively. This creates persistent demand that tightens supply over time. The US dollar and its safe haven status. The US dollar has long been considered the world's primary safe haven currency. During crises, global investors typically rush into dollar-denominated assets. This behavior is rooted in the depth, liquidity, and perceived stability of US financial markets. However, early 2026 has introduced nuance into this narrative. The dollar has weakened against several major currencies despite elevated global risk. This divergence has surprised many market participants. It suggests that while the dollar remains dominant, it is no longer unquestioned. Why the dollar is under pressure in 2026. The US dollar's softness reflects multiple overlapping forces. Expectations of future Federal Reserve rate cuts have reduced yield support for the dollar. Concerns about US fiscal deficits and debt sustainability have gained prominence. Political polarization has complicated long-term budget planning. Global investors are increasingly diversifying reserves rather than concentrating solely in dollars. None of these trends imply an imminent collapse. They do, however, reduce the dollar's relative appeal during certain risk cycles. This creates space for gold and alternative safe haven currencies. The Japanese yen as a defensive currency. The Japanese yen remains one of the most reliable safe haven currencies in the world. The yen tends to strengthen during global risk-off episodes. This behavior is driven by Japan's large net foreign asset position. During crises, Japanese investors often repatriate capital supporting the currency. Low interest rates in Japan also make the yen a popular funding currency. When risk appetite declines, carry trades unwind, boosting yen demand. In early 2026, yen appreciation reflects this classic defensive pattern. The Swiss franc and financial stability. The Swiss franc is another currency widely viewed as a safe haven. Switzerland's political neutrality, strong institutions, and conservative fiscal policy support this status. The Swiss National Bank actively manages franc strength to avoid excessive appreciation. Even with intervention, the franc remains a refuge during global turmoil. In 2026, demand for the franc underscores persistent investor caution. Gold versus safe haven currencies. Gold and safe haven currencies serve similar purposes, but behave differently. Gold is a real asset with no yield. Currencies offer liquidity and transactional utility. Gold tends to outperform during periods of negative real interest rates. Currencies tend to perform better when capital seeks short-term liquidity. In 2026, investors are increasingly holding both. This dual demand signals a lack of confidence in any single anchor. What this means for U.S. investors. For U.S. investors, the resurgence of safe haven demand carries important implications. Portfolios heavily concentrated in equities face heightened volatility. Traditional 60 to 40 stock bond allocations are under stress. Gold offers diversification benefits that are difficult to replicate. Currency exposure can also act as a hedge against domestic risk. Ignoring safe havens in 2026 increases downside vulnerability. Looking ahead, safe haven flows are not a temporary anomaly. They reflect deep structural shifts in the global economy. Gold and defensive currencies are signaling stress beneath the surface of markets. Understanding these signals is critical for navigating the years ahead. Gold, inflation, and real interest rates. Gold's performance in any economic cycle is deeply connected to inflation and real interest rates. Real interest rates are defined as nominal interest rates minus inflation. When real rates are positive and rising, gold typically struggles because investors can earn inflation-adjusted returns from cash or bonds. When real rates are negative or falling, gold becomes more attractive because the opportunity cost of holding a non-yielding asset declines. In early 2026, real interest rates in the United States remain volatile and uncertain. While headline inflation has cooled from peak levels, it remains structurally higher than the Federal Reserve's long-term target. At the same time, expectations for future rate cuts have pulled down long-term yields. This combination has compressed real yields, creating a supportive environment for gold. Investors are not convinced that inflation has been permanently defeated. They fear that renewed supply shocks or fiscal stimulus could reignite price pressures. Gold acts as insurance against that scenario. The Federal Reserve and safe haven psychology. The Federal Reserve plays a central role in shaping safe haven demand. Every shift in Fed language, projections, or policy expectations ripples through gold and currency markets. In early 2026, the Fed faces a delicate balancing act. On one hand, it must avoid reigniting inflation by easing policy too quickly. On the other hand, it must prevent excessive tightening from pushing the economy into recession. This uncertainty keeps investors defensive. Markets dislike ambiguity more than bad news. Gold benefits when policy clarity is lacking. Safe haven currencies also respond sharply to changes in Fed expectations. The dollar weakens when markets anticipate easing. Gold strengthens when investors doubt the Fed's ability to engineer a smooth landing. Recession risk and defensive positioning. Recession risk remains a key driver of safe haven flows in 2026. Economic growth in the United States has slowed meaningfully compared to prior years. Consumer spending shows signs of fatigue as excess savings decline. Corporate margins are under pressure from higher labor and financing costs. Manufacturing indicators remain uneven. While a deep recession is not universally expected, downside risks are elevated. In such an environment, investors prioritize capital preservation. Gold performs well during late cycle slowdowns. Defensive currencies attract capital during growth scares. The market's message is caution, not panic. Historical perspective on gold during crises. Gold's current rally can be better understood through historical comparison. During the 1970s inflation crisis, gold prices surged as purchasing power eroded. During the 2008 financial crisis, gold rose as trust in banks collapsed. During the COVID-19 pandemic, gold reached record highs amid unprecedented stimulus. Each episode shared a common theme of systemic uncertainty. The 2026 rally reflects a similar loss of confidence, though for different reasons. This time, the concern is not a single shock, but ongoing instability. Gold thrives in environments where risks accumulate rather than resolve. Supply constraints in the gold market. Gold's supply dynamics add another layer of support. Gold mining output grows slowly due to geological, environmental, and regulatory constraints. New discoveries are rare and increasingly expensive to develop. Production costs have risen due to energy prices and labor shortages. This limits the market's ability to respond to rising demand. Unlike fiat currency, gold supply cannot be expanded by policy decision. This scarcity underpins long-term price stability. When demand rises sharply, prices must adjust upward. Exchange-traded funds and investor access. Gold ETFs have transformed investor access to gold. They allow easy exposure without physical storage concerns. In 2026, inflows into gold ETFs have rebounded strongly. Institutional investors are increasing allocations as portfolio hedges. Retail investors are also participating amid market volatility. ETF flows amplify price movements by aggregating demand quickly. This mechanism accelerates safe haven rallies. Currencies reflect economic strength and geopolitical influence across global systems. Global fragmentation reshapes currency behavior as politics and trade realign. The US dollar remains dominant despite gradual competitive pressures globally. Safe haven demand favors the dollar during crises and instability. Yen and Swiss franc retain defensive appeal through institutional stability. Emerging market currencies weaken during risk-off investment environments periods. Capital consistently seeks stability over yield when uncertainty rises globally. Trust in institutions underpins the credibility of safe haven currencies. Central banks intervene to manage excessive currency movements carefully today. Market forces often overpower policy tools during periods of stress. Gold remains the primary hedge during systemic financial uncertainty events. Bitcoin volatility weakens its effectiveness as a reliable safe haven. Safe haven flows are driven partly by investor psychology dynamics. Fear-driven behavior accelerates movement toward familiar defensive assets globally. Gold benefits from collective memory built through repeated crises historically. Portfolio construction must adapt to shifting correlations between assets classes. Stocks and bonds diversify less reliably during market stress periods. Gold provides crisis protection when traditional diversification weakens significantly today. Bond markets signal risk sentiment ahead of equity markets frequently. Yield curve inversions warn investors of potential economic slowdowns ahead. High global debt increases vulnerability to interest rate shocks worldwide. Fiscal pressure limits policy flexibility across major economies globally today. Gold hedges risks associated with debt monetization and dilution concerns. De-dollarization reflects diversification rather than collapse of systems globally. Central banks increase gold reserves to enhance financial security resilience. Geopolitical tensions increasingly influence global capital flow decisions and stability. Energy price shocks elevate inflation risks across economies globally today. Technology accelerates market reactions and amplifies volatility across global markets. Institutional investors adjust long-term allocations toward real assets strategically. Gold fits structural objectives for pensions and sovereign funds globally. Risk managers model extreme geopolitical and financial shock scenarios regularly. Markets trade expectations rather than present economic reality consistently today. Gold reflects uncertainty expectations embedded within market pricing dynamics globally. Currencies respond primarily to policy credibility and fiscal narratives worldwide. Defensive positioning persists in 2026 amid heightened uncertainty globally today. Gold experiences corrections, yet underlying demand remains strong overall globally. Safe havens protect portfolios across multiple potential scenarios effectively worldwide. The dollar maintains dominance through unmatched liquidity and depth globally. Yield volatility introduces additional challenges for bond investors worldwide today. Foreign demand for treasuries remains selective and price sensitive globally. Gold diversifies portfolios against interest rate and policy risk exposure. Neutral assets gain appeal amid geopolitical polarization and sanctions risks. Gold neutrality remains unmatched among global financial assets today worldwide. Emerging markets face capital outflows during global risk aversion phases. Currency depreciation raises borrowing costs and financial stress levels globally. Gold demand increases globally during periods of instability and uncertainty. Media narratives amplify safe haven trends through feedback loops rapidly. Fundamentals ultimately drive sustained trends beyond short-term noise cycles. Markets are repricing risk in 2026 across asset classes globally. Understanding safe havens supports preparation, confidence, and long-term success. Thank you for watching and staying engaged with our channel. If you found value in this analysis, please like, subscribe, and share your thoughts below. As always, stay informed, stay disciplined, and stay prepared in a changing financial world. We'll see you in the next video. Goodbye, and take care.